global liquidity is one of the biggest correlates with Bitcoin price.
Right.
And there's really kind of two components of global liquidity when measured like that. One is the rate of credit formation, and then the other one is the strength of the dollar, because the global liquidity is often measured in dollars because a lot of the liabilities internationally, as I previously mentioned, are denominated in dollars. And so that dollar component is pretty important. And so you can either get more rapid credit creation to improve global liquidity, or you can get a weaker dollar around the margins, and that can improve global liquidity because you're basically changing the denominator at that point. And I think over the next 15 years, that trend's going to
Okay.
continue of less volatility. Basically, in my view, mainly around it being widely held. If
Okay.
something's not widely held, one big player can leverage and blow up and move the market, or buy in and move the market. Whereas when you get 5x or 10x more just broad distribution of the asset, you have more. There's historically been a cycle of distribution where during bull markets, kind of longer term whale holders will trim their holdings into that bull market and all that liquidity. And then during bear markets, generally kind of rotates back to the stronger hands. But every cycle, Bitcoin gets a little bit more distributed.
Lyn Alden begins by emphasizing the importance of global liquidity as a key driver of Bitcoin's price movement. She explains that global liquidity can be broken down into two primary components: the rate of credit formation and the strength of the US dollar. Since global liquidity is often measured in dollars, any fluctuation in the dollar's strength can significantly impact liquidity levels. A weaker dollar or increased credit creation tends to boost global liquidity, which, in turn, can positively affect Bitcoin's price. Alden anticipates another positive liquidity cycle in the coming years, which could serve as a tailwind for Bitcoin's performance. Alden reflects on Bitcoin's evolution over the past 15 years, noting that the cryptocurrency has become increasingly widely held. This broadening distribution has led to a decrease in volatility, as the market becomes less susceptible to the actions of large individual players. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
In addition to cross-border capital that has made that point a number of times, I've been in the camp that global liquidity is one of the biggest correlates with Bitcoin price.
Right.
And there's really kind of two components of global liquidity when measured like that. One is the rate of credit formation, and then the other one is the strength of the dollar, because the global liquidity is often measured in dollars because a lot of the liabilities internationally, as I previously mentioned, are denominated in dollars. And so that dollar component is pretty important. And so you can either get more rapid credit creation to improve global liquidity, or you can get a weaker dollar around the margins, and that can improve global liquidity because you're basically changing the denominator at that point.
Yeah.
And so I do think that in the years ahead, we'll probably get another positive liquidity cycle. We've been in kind of a stagnation there for a period of time as central banks try to tighten. I think we'll probably get another move upward, and I would expect as a base case for Bitcoin to do pretty well in that environment.
Yeah.
I think of a long time. I think, we're 15 years in, and I think over the next 15 years that trend's going to continue of less volatility. Basically, it's in my view, mainly around it being widely held. If something's not widely held, one big player can leverage and blow up and move the market, or buy in and move the market. Whereas when you get 5x or 10x more just broad distribution of the asset, you have more. There's historically been a cycle of distribution where during bull markets, kind of longer term whale holders will trim their holdings into that bull market and all that liquidity. And then during bear markets, generally kind of rotates back to the stronger hands. But every cycle, Bitcoin gets a little bit more distributed, kind of like a startup company becoming a publicly traded company over time, growing, its holder base gets more diversified. And when we hit a certain point, the volatility just, I think, will diminish over time, and the uncertainty around the asset will diminish over time. Yeah, so historically, Bitcoin and stablecoins have kind of been the two killer apps of crypto, right? They're the two things that have really caught on with traction through bull markets and bear markets alike. Bitcoin is an emerging store of value. Basically, it has superior monetary properties than most other monies we're familiar with. But because it's still small, it's still not widely held. People try to build leverage on it. It goes through these cycles. It's volatile as it reaches its whatever its total addressable market is, or as it gets close to what it eventually will be. Stable coins are just dollars in digital form. It helps serve the need for dollars globally. The demand for them. And there's two main use cases of stablecoins. There's one that's basically the unit of account for trading and DeFi on various crypto platforms. A lot of that's going to be on Ethereum. And then the other big usage of stablecoin is basically demand for dollars in the global south. Much of it satisfied by Tron. So there's almost like two different worlds of the same asset. As a near-term temporary store of value, like working capital, that's where stablecoins are very useful. Basically, the ability to tolerate volatility is somewhat of a privilege. Basically, the more financially comfortable you are, the more you can say, I'm willing to hold something for the next 4 years. Whereas stablecoins, you can kind of think of them as your checking account if you're in one of those environments where dollars are useful. Liquidity kind of begets more liquidity. And so far, Tether's network effect in this has been pretty remarkable, probably stronger than I would have guessed. I've also been watching some of the yield-generating stablecoins, or you can kind of think them as tokenized T-bills, things that try to pass on the yield to the holder rather than the yield being captured by the issuer. And even them, I mean, they've grown, but they're not exactly capturing market share very quickly. And so network effects are clearly pretty strong among stablecoins. And I don't have a firm view on how many there'll be or how much those network effects will entrench, because some of it is like a Boolean outcome of regulations, So some of the onshore ones try to, turn the arm of the state against the offshore ones, and you kind of go back and forth there. So there's some outcomes that I wouldn't try to predict. I do think it's rational for these various entities to try to get into the stablecoin market, given how big and potentially profitable it can be. But it's hard to judge the outcome. I think parts of the economy they're rather isolated from each other in this context, because we have a bigger than normal divergence between very loose fiscal policy and very tight monetary policy. And there are certain sectors that are more heavily affected by one or the other. And so, if anything, as we get kind of a softening in some of the areas that have been doing well, that allows the Fed to ease a little bit, which takes the pressure off some of the ones that have been held down monetarily. I think one of the bigger factors to watch in the upcoming years will be the dollar index, especially the dollar relative to various kind of emerging market currencies, because one of the big kind of feedback loops or forcing functions here is that the world has a lot of dollar-denominated debt. And ironically, it's not owed to the U.S. mostly. It's owed to other entities, like a country, its corporations or its government will owe dollars to China, for example. There's all these interconnected, and so as the Fed potentially cuts interest rates, I don't think it's going to be particularly impactful for the United States domestic market. I don't think anything under a 1% rate cut would be particularly notable, given how much fixed rate debt is already locked in below those levels. But any marginal cuts should be kind of decent for these emerging markets that have dollar-denominated debt. It kind of eases their burdens a little bit around the margin. And so I think a relatively kind of useful cycle to be aware of is the 2002 to 2007 cycle. Basically, the U.S. came, we had the dot-com bubble, and then we ran into basically a mild recession by most measures. It's more mild than recessions before it or after it. And instead, the next cycle was kind of led by global growth on the back of that easing, which I think I don't think we'll get the exact playbook, but I think it's a playbook to be familiar with.
A critical issue Alden highlights is the vast amount of dollar-denominated debt held by entities outside the United States. Ironically, much of this debt is not owed to the US, but to other countries, like China. As the Federal Reserve potentially cuts interest rates in the future, the effects might be more pronounced on emerging markets with significant dollar-denominated debt, easing their financial burdens. Alden draws a parallel to the 2002 to 27 cycle, where global growth was driven by easing monetary policies, suggesting that we might see a similar dynamic unfold, though not identical. Alden contrasts Bitcoin's settlement volumes with that of Fedwire, a US-based real-time gross settlement system. Despite Bitcoin's relatively low transaction count, its settlement volumes are strikingly large, similar to Fedwires, though Bitcoin operates 24/7 and is permissionless. This comparison underscores Bitcoin's potential as a global settlement layer, capable of handling significant value transfer despite its current size.
Well, one, I just like to compare the size of settlement volumes, because like you pointed out, it is a comically large number. America's GDP is measured in the tens of trillions, but actually gross settlement volumes are literally over a quadrillion. The reason I find that chart kind of remarkable is it's basically the same number of transactions that Bitcoin can do. Basically, it's somewhere around the same number of transactions per second on average. The difference being it's not 24/7 and it's permissioned. And so basically, Bitcoin is kind of like a Fedwire, but the global open source one so far much smaller.
I see.
And that's kind of why I made that comparison, is that you can build things on top of it. Fedwire handles a comically large amount of processing with a fairly small number of transactions because it's the bottom of a layered stack. So I consider this CPI report relatively unremarkable. Some aspects were in line, other ones were slightly out of consensus, but nothing particularly surprising. 3% is obviously psychologically notable, but there's no real significant difference between, say, 2.9 or 3.1 in the grand scheme of things. And I think that the bigger risk for CPI overall is, can they loosen policy while still keeping CPI down? And the driver on the other side of that is largely fiscal deficits. The fact that we're running much larger deficits as a percentage of GDP than we historically do, especially during an economic expansion, and a lot of that is now pretty structural. And so the question is, if they try to normalize rates back down to kind of a neutral rather than tight, and alleviate pressure from housing or alleviate pressure from small business loans, will that come with, say, an uptick in energy prices or other kind of drivers of inflation? So I view this less as, everyone's kind of like, can they get back to 2%? My question instead is, can you stick the landing? Can you get down to 2%, and then can you stay there rather than having a whole nother cycle materialize in the years ahead? So I think that given status quo, I think Tether's in a very strong position. A prime dealer now, for example, has been more supportive of Tether than the rivals onshore. And so, given an absent of very strong efforts to change that, I think the status quo likely continues. I think that domestically, obviously, some stablecoins could continue to gain market share, but globally, Tether is so far in the lead that it would take pretty heavy disruption for that to change. So my assumption is just current momentum continues. Like the biggest use case here is international. In the U.S., we generally have fairly good payment systems. Where we run into issues is when we're conducting business across border, and that's where stablecoins have been very useful. Some of it has been regulatory arbitrage, that things could be easier in the banks as well, but they generally have this more red tape on things. I don't try to judge timelines too much, and like I said, there are Boolean outcomes, legal outcomes, or lawmaker outcomes that I'm just not the expert in. But I just continue to be structurally bullish on the market cap of stablecoins. And for what we've seen so far, there are fairly strong liquidity network effects for the leaders.
Alden comments on the recent CPI Consumer Price Index report, describing it as relatively unremarkable, with most figures falling within expected ranges. She notes that the real challenge for the Federal Reserve will be to manage inflation while loosening monetary policy. With fiscal deficits running high, the risk of a resurgence in inflationary pressures remains a concern, particularly if energy prices or other inflation drivers increase. Alden questions whether the Fed can stick the landing by bringing inflation down to 2% and maintaining it there without triggering another economic cycle. Alden touches on the future of stablecoins, noting that Tether, in particular, is in a strong position despite regulatory pressures. She observes that the stablecoin market is influenced by a complex mix of regulatory outcomes and network effects, making it difficult to predict the future landscape. However, she remains structurally bullish on the market cap of stablecoins, given their strong liquidity network effects and growing international use cases. Please like and subscribe my channel.